Hi there, everybody. Ladies and gentlemen, hello and welcome to us here at Nadex. My name is Philip and I will be a presenter for today's webinar. Today it's about trading the global markets through binary options. Just as always, you see that small question box happily sitting on your screen. Please put a quick yes or Y in that box to just let me know that both the audio and the screencast are working properly. Let me change that first slide here. Perfect, guys. Thank you very much. Really appreciate that we have those technicals sorted out. And please don't be shy. Those sessions are designed that you guys can learn something about the markets, the way that I'm reading those charts and how to put those strategies and potential chart analysis into action. And therefore, if you do have questions, and I'm pretty sure there will be questions, please put those questions in there. Ask questions. You're not interrupting my flow. I really appreciate and I'm looking forward to interacting with you guys. That being said, today's session is scheduled to run for around about half an hour. Of course, if you have questions, we will cover those questions in every bit of detail that I'm possible to deliver. And yeah, just before we get started, there are our usual risk disclaimers. Please take a moment of your time to read through them and make sure that you're okay with them before continuing with the webinar. Essentially, this says that trading, of course, involves risk. And you should understand those risks and the risk that you put on your account when you're using specific instruments when you're trading those markets. As neither Trade with Position nor myself are investment advisors, nothing that we say should therefore be considered to be actual investment advice. All examples are shown for educational purpose only, especially true for the live part of this webinar. We will be looking at one or two markets together. I will tell you what I see on those charts. I don't have a crystal ball. I don't know what the market will be doing next. I can just share my analysis and in which I try to stack the odds in my favor. That being said, what means stacking the odds in my favor over a large sample set of trades? I should be able to have more potentially profitable trades on my hands than losing trades. And if I do proper risk management, and we want to see how we can do proper risk management in today's webinar, using binaries, I can also have that opportunity that those potential profits are larger than the losses. There will always be losses, but I try to tweak it that way that potential profits are larger than losses, and I tend to have more potential profits than losses. And those two things coming together, this is what gives me my edge with a trading strategy, and this is why I do look at those charts. That being said, before we get started, here's the Nadex risk warning coming up. Trading on Nadex involves financial risk and may not be appropriate for all investors. The information presented here is for information and educational purposes only and should not be considered an offer or solicitation to buy or sell any financial instrument on Nadex or elsewhere. Any trading decisions that you make are solely your responsibility. Past performance is not necessarily indicative of future results. Nadex contracts are based on underlying asset classes, including forex, stock index futures, commodity futures, cryptocurrencies, and economic events. Trading can be volatile, and investors risk losing their investment on any given transaction. However, the design of Nadex contracts ensures investors cannot lose more than the cost to enter the transaction. Nadex is subject to US regulatory oversight by the CFTC. That being said, let's have a look at today's agenda. Risk management, proper position sizing, trying to win more often. Okay, that's technical analysis. Trying to have larger winners. This is a good part, again, risk management and proper contract selection. And Nadex binaries and spreads, but today we want to focus here on the binaries, make it so easy for us to apply good, sound, proper risk management. And this is what keeps us in the game. You can screw up your entries and your exits for a very, very long time without wiping out your account if you apply proper risk management. So risk management is absolutely crucial. This is for survival. And we want to show and see here today how we can use binaries to apply good, proper risk management. Spec pricing and selecting the right contract. Obviously, we do have different strike prices, different markets to trade, different expiry cycles. And so the question is, all right, I have an idea about a certain market, but which of those contracts should I actually pick or not should pick? This would, again, be some kind of recommendation. The question is, what makes me lean more towards a certain type of contract in a certain scenario? Once again, what is my expectation for time, for price movement? And then this is where at the end of that decision tree, decision process, thinking, I arrive at, all right, for this setup, right now, my personal preference might be to take that contract. Practical binary trading scenarios and live trading and analysis directly here on the Nadex platform. So without much further ado, the advantages of trading binary options. Quick reminder, and guys, if you happen to have no knowledge at all what binary options are, please let me know and I'll do my very best to give you a very brief introduction here. Binaries are really simple, straightforward contracts. The basic idea here is I have a certain point in time when this contract will expire, and I have a certain strike price. And the only question that I have to answer for myself right now is, do I think that it is likely that the market will be trading above that strike price or not? Please note, it's an above the strike price. It's not strike price or equals. No, the equals part is already a member of that false event, which means that binary option will have a payout of 0. So it's a very simple decision that we have to make. Do we think that price will be trading above that strike price? Or do we think price, that won't be the case, price will be trading at or below the strike price at expiry? So the nice thing about those binary contracts is now they give us a straightforward capped risk derivative, which means I know my risk exposure upfront. Before I submit my order, the platform makes it incredibly easy to see for me how much money is it that I'm currently putting on the line, and also how much money can potentially be gained if that true scenario or if my position works out the way that I want it to work. But I know my risk upfront. And the ultimate trading decision that we have to face here is really just, it's a simple yes-no proposition. With plain vanilla options, you always have that question, how deep in the money will my contract be, and so on. That is of no interest here at all. It's just, is price above that strike price, is the price of the underlying trading above the strike price or not? And so ultimately they offer us an intuitive way to trade the financial markets with relatively low collateral. It's rather easy to open those trades. You don't have to have that huge trading account. Those of you who have some experience trading stocks and looking into day trading stocks, maybe just remember you have that pattern day trading rule in place, 25,000 US dollars, just to get rid of that rule, to show the SEC that you have enough buying power available to actually trade those markets intraday. All this is not the case here at Nadex. You can start with a very small account and still apply proper and sound risk management. So the benefits is, once again, you trade with strictly defined risk. Bad things happen. No political news can wake you out of your sound sleep during the night, because the market moved so much that you didn't anticipate it and now are in deep trouble. You always know the downside, the potential loss of that trade, the very moment you put it on. It is a low collateral requirement to open that position. Once again, you don't have to have those large accounts. Sure enough, you can easily trade those markets with large accounts here at Nadex as well, but you don't have to just to get started. Markets move, and those moves are either fast or slow. This is volatility. There are different volatility regimes in the market, fast-moving markets, slow-moving markets. The nice thing is, all those types of markets and market environments provide us with good trading setups and trading opportunities. And using binaries and spreads, we have enough strategies at our hand to actually cash in and apply those trading strategies in those different market environments. And those of you looking into trying to trade multiple expiry cycles, you have multiple daily trading opportunities here, of course. And maybe that formulation here is not, that phrase is not the perfect phrase. You can trade, obviously, as often as you want. Those binary contracts and spreads, those are not fire and forget types of trades. You open a position and you can actively manage that position. You can add to that position, you can close parts of that position or close it completely. You don't have to wait for this trade to hit expiry. So what we mean here is, with those multiple daily trading opportunities, you have different expiry cycles to pick from. So adding another level of choice here for your trading. So let's have a look at the markets together. All this was rather a very brief overview here. And the market which I like to focus on here for today is sweet crude oil. So what is it that we see here on that chart? I'm looking at the price of crude oil and I'm looking at a daily chart. We can get started here at first with a weekly chart. And you can see that weekly chart was for a very long time in a nice uptrend. Why are we looking at this chart? Wait, Philip, you just told us we're talking about binaries here. So why the chart? The chart is always the reason for me to take a trade. I don't sit down at my trading desk in the morning and decide, okay, today I want to trade euro against the US dollar. I want to see a setup. I have a trading strategy. I perform a certain type of technical analysis, and for that, I'm looking at the chart. And only when I see my setups setting up and developing there, then is it that I decide that I want to trade this market, and then is the next step, okay, how can I trade this market? What is the best way to implement that trading strategy? And this is when I start to look at the spreads. This is when I start to look at the binaries, at the different expiry cycles, the different strike prices, and so on. So the trade always starts for me with a chart. I must have an idea why this market could be moving, and if I have a certain type of movement that I'm anticipating, which I have observed several times in the past. And what is it? Observing something several times in the past, I try to extrapolate that and think, all right, might happen again in the future. Once again, past results are definitely not indicative of future results, but it's all about probabilities. And if it has happened 60 times out of 100 times, I feel that there might be an edge, and this is how I want to trade. So looking at this chart, weekly chart of crude oil, beautiful, nice uptrend. And there are certain things to see here which help me to see that this is an uptrend. First and foremost, I can see the price is making higher highs all along the way. And we get pullbacks from time to time. Those pullbacks take us back here to what we like to call price equilibrium levels. This is just another fancy way of saying price has a tendency to return to its moving average from time to time. Price can never go exponential, ballistic, and never come back. It is always the price will be returning to the moving averages. This can happen in two ways. The first way is price is pulling back to those moving averages, or price decides then to just move sideways for a little bit of time, so that that the moving averages have time and potential to catch up. Either way, too far away from the moving averages, pulling back. Same thing here. Price is now in a downtrend. We started to see lower lows here on the weekly chart, and price dropped by quite a bit on that weekly chart. The moving averages, which have been fanning here for a nice uptrend, the black happens to be the 10-period moving average. Blue is the 20-period moving average, red is the 50, and green is the 200. And I don't care if you use the simple or the exponential moving average. Try both, see what you like best for your own trading style and what makes it easier for you to read those charts, but then stick with your choice. Don't switch around. For this market, I like the simple better. On that market, the exponential seems to do the trick. No, the way I analyze those charts and markets, I use the same set of indicators. I use the same type of analysis, independent of what the market is and independent of what the time frame is. So once we drop down here to a daily chart, it will just stay the same. No changes here, no nothing. Any market, any time frame. So price is clearly making lower lows here. Those moving averages have now started to fall into place for a downtrend. 10 already obviously trading below the 20, and the 20 is about to just move below the 50. But right now we are overextended here. We moved away from this moving average sell zone. And just for that reason, some kind of pullback might be setting up here. What could be a way to identify potential pullback targets here? And one thing that we like to use is here our pivot points. Simple normal pivot points, They are another type of leading indicator, and those are here currently the pivot points drawn from the monthly data. The usual pivot points are always used just using daily data. So I take yesterday's open, high, low, close, push it into my formula, and it gives me for the next trading day, for today, a set of levels which I can use for my trading. And there's nothing that prevents me to apply those same calculations just using monthly data. So I'm taking last month's open, high, low, and close data, put it into my formula, and arrive at those pivot points here for the current month. And so I can see, all right, the market has a tendency to push and move towards those pivot points, resistance levels, support levels. Does it work perfectly? No, nothing ever does with trading, but it has a certain type of probability that those levels could act as some kind of magnet pulling price towards them, if you like that picture. So this is one level here where I say, okay, price might be pulling back there or there or there, which here would be way too deep for a pullback. Another type of leading technical indicator that I could be using is, let's make it a little bit larger here, are of course my FIB retracements. How do I draw those FIB retracements? I take my last swing point high here, and from this last swing point high, I draw my FIB retracements to the recent swing point low. The idea here is that price is pulling back, or has pushed down, and now I'm starting to see a little bit of bullish action setting up here. Right now, this is way too little bullish action. The candle A is still printing, and B, this pullback here, we start to see this long upper shadow, definitely some more bearish action going on in this candle here right now. However, I feel that if we tend to get this pullback and this level here truly has been identified as the new swing point low, then suddenly this area here starts to become rather attractive for me. Why? I do have a monthly pivot point waiting here for me. I know that this level of 38.2% retracement is sitting very, very close to this level here. So if the market truly starts to pull back, I feel that this area is probably a little bit more significant than other levels. Let's put it that way. And by the way, by the time we will get this pullback, probably those moving averages will have caught up, so that all of those things might be coming together here in this level, something around 60, 61 in this area. That's the weekly chart. Let's drop down our time frames here to the daily chart. And you can see I still have that huge move here. And now on the daily chart, I not only have my monthly pivot points, I can also put on here my weekly pivot points. And now, once again, 38.2% FIB retracement, sitting very, very close to my R2 from the weekly chart, my S1 from the daily, from the monthly chart. So once again, this level becomes rather attractive here. Do we get a pullback? Not sure. Yesterday's price action looked much like that pullback. Today's price action looked a long time rather bullish. Right now, it has returned here to this rather bearish candle setup. Let's drop down here to the 4-hour chart. The case that I had prepared for today was, and this was when this candle was still looking rather bullish, the idea was to trade a potential counter trend trade. What does this mean? We have seen that the market is in a downtrend on the weekly chart. We have seen that the trend obviously was a downtrend on the daily chart. And the one thing from the daily chart, we are still overextended here at those price levels, and I feel that some kind of pullback here, at least to those price equilibrium levels here around, let's say the 55, something like that, could be rather likely. However, the overall momentum in this market is going down. So if I think the market might be pulling back, I should adjust my risk exposure for that. Usually I tend and want to trade and risk only 1% of my account on any one given trade. And I do have that great demo account, simulated account here at Nadex, and this is currently sitting at something like $22,000. This means risking 1% of my account. I would be shooting for a risk exposure of around about $220 on that trade. If it was a counter trend trade, I would be risking maybe half of that. So I could be risking around about $110. Now, I'm not suggesting that we will get this pullback. I do not suggest that the market is continuing right now. Right now, for me personally, this is right now pretty much in no man's land, and it's not really that strong going either way. I will show you, however, two different ways to potentially trade this market here. Let's have a look at the 15-minute chart. At the 15-minute chart, you see this is a mess right now, pretty much going sideways, strong bearish movement coming in here, but overall this market is just moving sideways. Let's have a look at the 5-minute chart. Better, but here once again we might see that the market might start to do a small pullback. Why? Because right now we are overextended. Let's push this here to the right side. Let's get rid of this and try to bring in the Nadex platform. What I'm seeing here right now is this market is sitting at 50.80, and I'm looking here at a potential trade in the daily option expiry. Why? Because it gives me right now 2 hours and 7 minutes of potential trading time. So the question is, if I think that this is overextended, if I think the market might be pulling back and give me some time of pullback, I could start to think now, okay, which of those contracts might be interesting for me? And right now, I think that the 51, and you see this market is moving fast. If I think the market is pulling back towards 51, I could be looking into potentially buying here this 51 contract. And first thing, I would like to demonstrate how I do now my position sizing. And then I would explain why I'm looking at the 51 and why I would consider, how I could consider to manage that trade. So looking at buying this contract here, I think we might start to see a small pullback here, looking at the 51. It's a counter trend trade. The overall picture is bearish. The short-term picture is bearish. If I want to speculate on this potential counter trend move, $22,000, I want to risk 0.5% on my counter trend trade, and therefore I just dial up my number, my trade size here, until I can see that my maximum loss is around about in this area of 0.5% of my account, $110. Trading 5 contracts would be too much. So I'm shooting for 4 contracts here right now, and I place that order. And the position is live. All right, now we do have a little bit more time. Once again, I do not suggest that you mirror my trade. One random guy on the internet telling you that he likes a certain market on a educational webinar trying to illustrate some concepts. Guys, this should never ever be good enough for you to actually risk your money. We want to learn something here. So why did I go for that 51 contract? The idea is that if the market is shooting towards 51, I have a potential, I see the potential that this market, this contract could be trading at around about $50. I paid now $24.50. Why do I think it might be trading around about 50? Because if a binary option, the underlying market is trading at the strike price of that binary option, the way that those contracts are priced, plain vanilla options, the calculation of delta and so on, the idea is that if it's trading at the money, then the price should be somewhat close to 50. Could be 40, could be 60, but should never be 20 or 80, for example. Unless we have very, very little time and gamma is really kicking in heavily. Normal expiry cycle and so on. If we get this pullback towards 51, then there's a decent probability that this contract could be priced for around about 50. So strike price 51. The idea here obviously is I want for this contract to be fire and forget. I would expect price to go and shoot beyond 51 and close there to get the full payout. And the full payout would be 4 times $100, $400. So I have now a risk of around about $100 for potential to make $300. 3-to-1 reward to risk ratio is very nice. However, do I think that it's likely? No, I don't think so, because ultimately this market is currently dropping like a stone, and getting this pullback to 51 might still happen. But am I feeling bold enough to actually say, all right, and then once it goes there, it will stay there, and I will endure and wait for this option to expire? No, I won't. This is why it's so great to actually be able to manage those trades. Now, what I can do is I'm risking now 24.50 per trade, and I'm putting in a limit order. I'm looking into selling 2 of those contracts for a potential price of 50. I'm not closing my whole position. I'm putting in a limit order to say if price spikes up towards 50 and does give me that roundabout 50 price as it's trading at the money, I want to scale out. I want to take risk off the table, and at that stage, I still own 2 contracts, and they didn't cost me anything, pretty much. Let's forget about the commissions here for a moment. Why didn't they cost me anything? Well, because I made $25 on 2 contracts, and I'm risking $25 on the remaining 2 contracts each. And so what I gained on that potential push higher here towards 51 might be just canceling out the risk that I still have on the remaining 2 contracts. So placing that order just means I have this limit order waiting here, and I can do this more sophisticated. I can say, all right, I've taken now care of 2 of those contracts, and another thing might be, all right, I want to go for another 1 of those contracts. Once, let's just assume we get a really sharp spike back, sharp push back, and price even hits 75. All right, I will close another 1 of those contracts if price happens to hit 75. So this is just one potential way to manage those trades and manage those positions. Now, do I think that it's a perfect, I see this market is dropping. Philip, come on, you must be shorting this market right now, right? No, absolutely not, because price has pushed away from its price equilibrium levels by quite a bit. Just see the distance between the 10-period moving average and where price is currently trading. And I've shown you that price has a tendency to come back to price equilibrium levels. And so if I try to sell this market right here, all this could happen as a snapback. I'm taking this additional risk if I'm looking into shorting this market. Doesn't make any sense for me. I want to have a high probability setup, and therefore my perfect trade situation would be I would be waiting for price to come back to those price equilibrium levels, and once price is there and showing me signs that the market might be turning, then I would be looking into selling a corresponding contract. And I would pick this contract to be, why talk about it if I might be able to show it? And by the way, this fast move here on the 5-minute chart with this huge overextension, looking at the 1-minute chart, you can see this is a much more smoother experience, and try to get a feeling how those different time frames are connected. How does one chart on the 5-minute chart would look on the 1-minute chart, on the 15-minute, on the 30-minute chart. So the idea is price pushed lower here and came back towards those price equilibrium levels. And here in this area, that might have been a shorting opportunity. The overextension had been fixed, price is pushing lower. And here now just you see on the 5-minute chart, you see longer, lower shadow. You start to get a bullish kind of candle here. Price starts to pull back. That's the 5-minute chart. On the 15-minute chart, you still see, all over the place. But the 1-minute chart, clearly you start to see this pullback, and this pullback going strong. What might be an area for this pullback? Well, overall, the moving average sell zone here, but I can just as easily apply my fib retracements here once again, and so on. So right now, this pullback move is on its way. 51 might be a little bit aggressive here right now. Probably 50, 70, 50, 80 might be better suited. But this was really just to illustrate the idea here. Now, price is sitting right here. If I think that price might be shooting lower, and I lost my platform. Here it is again. If I think the market might be going lower, let's just look at potential short trading opportunity here. I think price might be shooting lower to test again this 50-30 level. So, and unfortunately, the market has moved by quite a bit. The lowest contract that I could be trading here is 50-50. All right, sure, why not? So looking into shorting this contract here, just for the sake of balancing the long and the short setups, again, this is not recommended. If I sold one of those contracts, my maximum loss would be 28.25. Why? Because right now we are sitting here right in the money. Price of the underlying is trading above this level, and therefore price is above 50. So I could be looking into selling this contract now. My loss, potential loss 26.25, my maximum profit 73.75. If I think this market is going down, if I have built a strong case that this market is going down, I want to risk 1% of my account, not the counter trend trade, but now it would be a trend following trade. And you see, I have to get a little bit faster, which is why I don't like to trade those fast time frames. You guys are younger and quicker than me, and therefore it just works fine. All right, looking into selling this contract here, and just place the order. So looking into selling that 50-50 contract for a price of 71.75. Now, if we do get a fill here, what's a potential battle plan? What was my risk on that trade? Well, 71.75 to 100, 21.25. That 28.25. That's my risk. I can do the same logic here once again. If I think that price will drop to 50-50, then that contract should probably be trading around about 50. And this could mean I can easily put in my take half position off at a price of 50. Same logic applies here as we've seen when the market moved lower. Guys, does all this make sense? Do you happen to have any questions? We seem to be good. And just in case you might be typing your questions, let me just move quickly here back to the slides. The type of analysis I perform is always the same. It's always the same. I'm looking for a trend, and then I have to decide, is it a counter trend trade? I want to risk less, half of my usual position size. If it's a trend following trade, I want to go with the direction of the trend, and I'm willing to risk 1%. My moving averages just help me to identify those setups and the overall market theme easier. In the end, I just need my candlesticks. I just should be able to read price action. Reversal candle here at overextended levels. It's rather possible to get this pullback. We got the pullback to price equilibrium levels. You see the candles become more indecisive, a little bit more bearish. And the next thing probably is price might be going lower to test this low. What makes a downtrend? Lower lows and lower highs. And simple as that. And you don't need any fancy indicators of stuff. It's just really, I use those indicators, scanning for convergence, divergence, and so on, to see certain aspects of price action faster and easier. And then once you found that setup, then you decide which way do you want to trade. Do I use spreads? Do I use binaries? And risk management first. I always dial in. I have my expectation, then I pick the contract, and then the trade size is completely determined by my money risk that I'm willing to take on that trade. Scott, thank you very much for the feedback. Really appreciate it. Guys, that's it already for today. Time flies if you're having fun. I hope you enjoyed today's webinar as much as I did, and you learned something new, something useful. And I'm really looking forward to welcoming you guys again over the next few weeks. If you happen to have any questions, please let us know. And right now, over those next few days and weeks, guys, happy trading. Good luck with the markets. I wish you all a great and happy trading day. Once again, take care. Thanks again, and bye-bye.